The indices are exhibiting a relatively subdued picture as we awaken. We're seeing modest shifts across the board in the futures space. A slight easing in the broader market indicators, a subtle dip in the technology-heavy contracts, and a similar gentle retraction in the small-cap segment. These movements, while seemingly minor, are highly consequential. They reflect the market's digestion of recent news, its anticipation of fresh data, and, perhaps most profoundly, the immediate implications of a pivotal leadership change at the Federal Reserve. Indeed, the underlying narrative is one of careful recalibration. Investors are weighing the immediate economic signals against the backdrop of evolving monetary policy expectations. We are in a transitional period, and every fraction of a percentage point in these futures tells a story of cautious positioning. The volatility gauge, often a barometer of investor anxiety, is showing a modest decline, suggesting that while there's a definite sense of watchfulness, outright panic isn't the dominant emotion. This morning, the financial world is less about sharp, reactive moves and more about the quiet, deliberate repricing of assets in the shadow of a changing guard. The financial landscape is always shaped by the pronouncements and actions of its most influential players, and this past 24 hours has been no exception. From the titans of industry to central bank governors, their words and decisions ripple through every facet of the market. Let's start with the banking sector, where Jamie Dimon, the formidable head of JP Morgan, continues to make headlines. His firm stance on employees returning to the office is more than just a corporate policy. It reflects a broader philosophical view on productivity, collaboration, and the future of work. Reports of employees feeling significant pressure to comply speak to the authority Dimon commands, and the implications for corporate culture across Wall Street are profound. It's a testament to the ongoing debate about the long-term impact of remote work on efficiency and innovation within the financial engine room itself. Moving to the innovation frontier, Elon Musk, ever the disruptor, has reportedly pivoted SpaceX's strategic focus from Mars to the Moon, particularly as the company eyes a potential public offering. This shift isn't just about space exploration. It has direct implications for capital allocation, technological development, and the competitive landscape of the private space sector. It underscores the immense capital requirements and strategic flexibility demanded by such ambitious ventures, and how even the most visionary leaders must adapt their goals to market realities and investor appetites. In the semiconductor world, Jensen Huang, the CEO of NVIDIA, continues his ascent, now recognized among the world's top billionaires. This isn't merely a personal achievement, it's a powerful symbol of the AI revolution's immense wealth creation. NVIDIA's performance isn't just about microchips, it's about powering the future of artificial intelligence, a theme Larry Fink of BlackRock also touched upon. Fink's admonition that AI will fail if people remain spectators, rather than owners of growth, is a direct challenge to the market. It's a call to engage, to invest, and to participate actively in this transformative wave, reminding us that passive observation will lead to missed opportunities in this new technological paradigm. The implication is clear. Those who actively embrace and invest in AI's foundational technologies are the ones poised for significant returns. Across the Atlantic, European Central Bank President Christine Lagarde delivered an important message on the Eurozone economy, reiterating her expectation for inflation to stabilize at the ECB's target. This provides a crucial counterpoint to the domestic discussions around inflation, highlighting that while the US grapples with its own price pressures, major global central banks are navigating similar, yet distinct, challenges. Her confidence in reaching the inflation target offers a degree of stability for European markets and can influence global investor sentiment. The bond market, often the quiet engine of the financial system, is sending some interesting signals this morning, particularly concerning the benchmark 10-year Treasury yield. We're observing a modest retreat in yields, a move that often suggests a market grappling with future economic expectations and, crucially, the direction of monetary policy. This slight downward pressure on yields could be interpreted in several ways. On one hand, it might reflect a degree of caution ahead of upcoming key economic data, such as the inflation figures and the jobs report that are looming large this week. Investors might be seeking the relative safety of government bonds, pushing prices up and yields down, as they await clarity on the economy's health. On the other hand, this movement is undoubtedly intertwined with the seismic shift at the Federal Reserve. A new chair at the helm brings with it a fresh perspective and, potentially, a revised approach to interest rate policy. The market is already trying to price in what the Walsh era might mean for the path of rates. Does a slightly lower yield suggest an expectation of a more measured approach to rate hikes, or is it a preemptive move based on fears of a growth slowdown under potentially tighter conditions? The Wall Street Journal's recent piece on why inflation might come in hot next, however, adds a layer of complexity. If inflation indeed proves stickier, then the current yield dip might be short-lived, as the new Fed leadership would face immediate pressure to maintain a hawkish stance. The tension between anticipated inflation and the market's initial reaction to new leadership creates a fascinating dynamic. This is a market in flux, carefully balancing potential economic overheating with the prospect of more stringent monetary policy. The central bank landscape is undergoing its most significant transformation in recent memory, with Kevin Walsh assuming the mantle of Federal Reserve Chairman. This is not merely a personnel change, it represents a potential philosophical shift in the world's most powerful central bank, and its implications resonate globally. Walsh, known for his more hawkish leanings and a strong belief in market-based solutions, takes the helm at a critical juncture. His appointment, as highlighted by J.D. Supra, signals a clear intent to perhaps lean more aggressively against inflation. We can expect his focus to be acutely tuned to price stability, potentially prioritizing it even over short-term growth considerations. This could mean a less accommodative stance than markets have grown accustomed to, and a higher threshold for intervention. The Federal Reserve Bank of New York's previous observations on interest rate surprises when the Fed doesn't speak take on new meaning now. With Walsh, markets will be dissecting every public statement, every nuance, for clues on future rate trajectories and balance sheet management. His potential preference for clearer communication and perhaps a less activist Fed could introduce periods of greater market volatility as participants adjust to a more principled, rather than pragmatic, approach to monetary policy. The market's initial reaction to him will be crucial. What are the practical implications? Under Walsh, we might anticipate a less patient approach to inflation. This could translate into a faster pace of interest rate increases, or at least a firm commitment to keeping rates elevated for longer to anchor inflation expectations. For the bond market, this implies continued vigilance against rising yields, especially if economic data supports a hawkish stance. For equities, particularly growth stocks, higher rates could pose a challenge by increasing the cost of capital and making future earnings less valuable. Simultaneously, across the globe, the European Central Bank, as Christine Lagarde affirmed, is maintaining a steady course. This divergence in central bank leadership and strategy, a potentially more hawkish Fed under Walsh contrasting with the ECB's commitment to stability amid inflation fluctuations, sets up an intriguing dynamic for currency markets and global capital flows. A more assertive Fed could strengthen the dollar, impacting everything from commodity prices to the competitiveness of multinational corporations. The world is watching closely as the new era of monetary policy under Chairman Walsh begins to unfold. The commodity markets are always a fascinating barometer of global economic health and geopolitical tensions, and this morning's movements offer a complex picture. Gold, often seen as a safe haven asset, is experiencing a slight pullback. This dip below the $5,050 mark, as FX Street notes, could be attributed to several factors. In an environment where the new Federal Reserve Chair is perceived as potentially more hawkish, the prospect of higher interest rates and a stronger dollar can diminish gold's appeal as a non-yielding asset. Additionally, if there's any perceived easing of geopolitical tensions, some of the safe haven premium can evaporate. However, China's ongoing buying interest is seen as a key factor limiting further downside, indicating that underlying demand for the precious metal remains robust from strategic buyers. This creates a fascinating push and pull, where short-term sentiment battles long-term strategic accumulation. In the energy markets, crude oil is showing a modest uptick. This slight gain comes despite news from CNBC that oil major BP has suspended share buybacks, a move often indicative of internal capital expenditure needs or a more cautious outlook on future profits. The resilience in oil prices suggests that underlying demand remains robust, or perhaps that supply concerns are resurfacing. Geopolitical factors, such as tensions in key producing regions, or a re-evaluation of global demand forecasts, could be contributing to this slight upward momentum, even as individual companies adjust their capital return strategies. Conversely, natural gas prices are seeing a decline. Natural gas intelligence attributes this slide in next-day prices to decreased demand driven by milder weather. This highlights the highly seasonal and weather-dependent nature of the natural gas market. As temperatures moderate, the immediate need for heating fuel diminishes, putting downward pressure on spot prices. This serves as a reminder that while broader energy trends are important, specific commodities often react acutely to immediate environmental and demand-side factors. The divergent movements in oil and natural gas underscore the granularity required in commodity analysis. Each market tells its own distinct story, influenced by unique supply-demand dynamics. Diving into specific sectors reveals a continuation of some familiar themes, alongside new narratives emerging from the broader market shifts. The tech sector, as always, is at the forefront of this evolution. We are seeing robust performance from companies like Microsoft, Meta, and Nvidia. This strength is largely attributable to the unabated enthusiasm for artificial intelligence. Microsoft's strong showing suggests continued confidence in its cloud computing prowess and its strategic investments in AI. Meta's rally could be linked to advancing deals in AI data centers, as well as broader analyst sentiment on companies benefiting from AI infrastructure build-out. And then there's Nvidia, which has been a bellwether for the AI revolution. Jensen Huang's personal wealth surge is a direct reflection of Nvidia's pivotal role in supplying the computational backbone for AI development. As Larry Fink articulated, the opportunity in AI is for owners of growth, and these companies are clearly perceived as being at the vanguard of that ownership. However, not all tech giants are enjoying the same momentum this morning. Apple is experiencing a slight retraction, while Amazon also shows a dip. These movements could indicate a rotational shift within the tech space, perhaps a move away from consumer discretionary-focused tech toward pure AI infrastructure and enterprise solutions. For Apple, concerns about global consumer spending or supply chain nuances could be at play. Amazon, while a powerhouse in cloud services, also has a significant retail footprint, which can be sensitive to broader economic sentiment. It's a nuanced picture, suggesting that while the AI tide is lifting many boats, not all ships are sailing with equal speed. Beyond the immediate tech giants, the AI revolution is creating ripples everywhere. Broader analyst sentiment on companies like Broadcom, for example, remains bullish due to growing demand for Google's specialized AI chips, known as TPUs. This signifies that the AI growth story is not confined to the usual suspects, it's permeating the entire technological supply chain. In essence, the market is continuing to reward companies that are demonstrably investing in, and benefiting from, the proliferation of AI technologies, while those without such a clear narrative might face more scrutiny. The digital asset space continues its characteristic volatility, and this morning, we're observing a pullback across major cryptocurrencies. Bitcoin and Ethereum are both experiencing notable declines. This movement is a stark reminder of the nascent nature of this market, where sentiment can shift rapidly. However, the story in crypto is far more complex than simple price action. It's deeply intertwined with corporate adoption and institutional strategy. The performance of MicroStrategy, for example, offers a fascinating counter-narrative this morning. While Bitcoin is lower, MicroStrategy's stock is actually seeing a modest gain. This divergence speaks volumes about the market's perception of its CEO, Michael Saylor, and his unwavering commitment to Bitcoin. Saylor's philosophy, often articulated as MicroStrategy being a digital intelligence company leveraging digital credit to acquire digital capital in Bitcoin, continues to resonate with a segment of investors. They view MicroStrategy not just as a software company, but as a publicly traded vehicle for Bitcoin exposure. This strategy, however, is not without its critics. Barchart.com recently highlighted an analyst who foresees MicroStrategy and Saylor taking Bitcoin prices to zero, underscoring the intense debate surrounding corporate Bitcoin strategies. This bearish perspective often cites the volatility of Bitcoin itself, the debt taken on by MicroStrategy to acquire it, and the potential for regulatory headwinds. Yet, the market's continued support for MicroStrategy, even on a down day for Bitcoin, suggests that a significant portion of investors are buying into Saylor's long-term vision, betting on the ultimate success of Bitcoin as a store of value and an institutional asset. The implications of MicroStrategy's strategy are far-reaching. It tests the boundaries of corporate treasury management, pushing companies to consider alternative assets. It also highlights the growing bifurcation in investor sentiment towards cryptocurrencies, those who see them as the future of finance and those who view them as speculative bubbles. As Warsh's Fed potentially introduces a more stringent monetary environment, the appeal of decentralized digital assets as a hedge against traditional financial systems could either strengthen or weaken, depending on how investors perceive the long-term implications of tighter money. This makes the crypto corner an exceptionally dynamic space to watch in the coming months. As we look towards the trading day ahead, particularly in light of the US market being closed and our focus on futures, the narrative is firmly centered around two critical pieces of upcoming economic data: the latest US Inflation Consumer Price Index report and the job market report, both due out this week. These are not merely statistics, they are the fundamental underpinnings that will shape monetary policy and market sentiment. The Wall Street Journal's recent warning that inflation may be about to come in hot sets a nervous tone. If the CPI report indeed shows higher than expected inflation, the implications for the new Federal Reserve Chair, Kevin Warsh, are immediate and profound. A hotter inflation print would place immense pressure on him to demonstrate his commitment to price stability, potentially leading to a more aggressive stance on interest rates. This could cause bond yields to spike, putting further pressure on growth stocks and sectors sensitive to borrowing costs. Conversely, a softer inflation reading, though less anticipated, might provide Warsh with a bit more breathing room, allowing for a more gradual approach, though his known hawkish tendencies might still lead him to err on the side of caution. Following closely will be Wednesday's report on the job market, as Investopedia highlights. A strong jobs report, indicating robust employment and wage growth, could reinforce inflationary pressures, pushing the Fed towards a more hawkish stance. A weaker report, however, could signal economic cooling, potentially easing some of the immediate inflation concerns but raising questions about the strength of the recovery. The interplay between inflation and employment data will be the primary drivers of market behavior this week. For traders, this means extreme vigilance. The futures markets will be highly reactive to these numbers. Any significant deviation from expectations could trigger sharp movements across all asset classes, from equities to commodities and currencies. Investors will be attempting to front-run the Federal Reserve's potential reaction function under its new leadership. Will Warsh prioritize inflation fighting even if it means sacrificing some growth? Or will he take a more nuanced approach? The incoming data will provide his first major test and offer the market its first real glimpse into the Warsh era of monetary policy. Prepare for a week of data-driven volatility and strategic positioning. As we conclude our morning update, the overarching theme is clearly one of transition and re-evaluation. The financial world is navigating the early days of a new chapter at the Federal Reserve, with Kevin Warsh at the helm. This leadership change is not just cosmetic. It signals a potentially more hawkish era focused intently on inflation, which will ripple through bond markets, corporate borrowing costs, and investment strategies globally. We've seen the market already beginning to digest this, with nuances in bond yields and a watchful eye on upcoming inflation and jobs reports that will provide Warsh with his first major challenge. Simultaneously, the relentless march of technological innovation, particularly in artificial intelligence, continues to drive sector performance, creating clear winners in companies powering this revolution, while other segments of the market face different headwinds. Commodities tell a tale of divergent forces. Gold balancing safe haven appeal with interest rate expectations, oil reflecting persistent demand despite corporate caution, and natural gas reacting acutely to seasonal weather patterns. And in the fascinating realm of digital assets, the corporate conviction of entities like MicroStrategy continues to fuel debate and selective investment, even as the underlying cryptocurrencies experience their characteristic volatility. My final take for you this morning is this. In an environment defined by a new Federal Reserve paradigm and ongoing technological disruption, adaptability and deep analytical insight are paramount. Understanding the why behind market movements, rather than just the what, will be your most valuable asset. The market is not just reacting to numbers. It's anticipating a new philosophy, and those who can best decipher its implications will be best positioned for the opportunities and challenges ahead. Stay vigilant, stay informed, and always approach the market with a well-reasoned perspective. Thank you for joining me.